Picture this. You open your account on a normal Tuesday morning. Your portfolio is down 32% from the high. Nothing in your life changed overnight, but your stomach drops anyway. Now the real question hits. Is this a normal drawdown, the kind you must pay to earn long-term returns, or is this the start of a path to ruin? A drawdown is the percent decline from a previous peak to a later low. It is not the same thing as volatility. Volatility means how much prices bounce around day to day or month to month. Drawdown is what it feels like when the bouncing goes against you and does not come back quickly. Investors say they can handle risk, but drawdowns are where risk becomes real. Here is the part most people miss. The market does not hand you returns smoothly. It hands you a messy sequence. Sequence risk means the order of gains and losses matters, even if the average return looks fine on paper. If you are adding money over decades or withdrawing in retirement, the same long-run average can lead to very different outcomes depending on when the drawdowns arrive. Look at 2008. A diversified stock portfolio fell hard. Many broad equity indexes dropped more than 50% peak to trough. That is a drawdown that changes behavior. People sold near the lows, not because they were stupid, but because their plan did not include a drawdown that deep. The risk was always there, but it was not emotionally priced in. Then the market recovered over time. The lesson is not that markets always recover. The lesson is that your ability to stay invested is part of the strategy, and drawdowns are the tax you pay for owning risky assets. Now I want to make drawdowns concrete. If you lose 50%, you need 100% gain to get back to even. That is not a motivational line. It is basic arithmetic. Losses compound against you. This is why controlling drawdowns matters more than chasing the last bit of upside. It is also why leverage is so dangerous. Leverage means borrowed exposure. It multiplies gains and losses. It can turn a normal drawdown into a career-ending event. Long-term capital management, LTCM, is a classic case. They had brilliant people and sophisticated models. They also had leverage stacked on trades that looked low risk most of the time. Their problem was tail risk. Tail risk means rare outcomes that are far more extreme than normal day-to-day moves. In 1998, when Russia defaulted and markets seized up, correlations jumped. Correlation means how much assets move together. In calm markets, some trades look diversified. In a crisis, they can all move the same way. Liquidity vanished, meaning they could not exit positions at reasonable prices. A drawdown became a spiral. When you are forced to sell into illiquid markets, you turn paper losses into permanent losses. That spiral is not abstract. It is reflexivity. Reflexivity means your actions change the market that then changes your results. If you are big and leveraged, your selling pushes prices down, which forces more selling. Drawdowns become self-reinforcing. This is why I teach that drawdowns are not only about the asset, they are about the structure around the asset. Position sizing is the simplest control. Position sizing means how much of your capital you put at risk in one idea. A great idea with too much size can still wipe you out. A mediocre idea with small size might be survivable. Survival is the first edge. People love the Kelly criterion, so let me define it carefully. Kelly is a formula for sizing bets to maximize long-run growth when you know your edge and your odds. In real markets, you do not know them with certainty. Estimation error means your inputs are wrong. If you size as if your estimates are perfect, you will likely oversize. Oversizing increases drawdowns and increases risk of ruin. Risk of ruin means the probability you hit a loss so large you cannot recover, either financially or psychologically. Many professionals use fractional Kelly, meaning smaller than the formula suggests, because drawdown control matters more than theoretical growth. Warren Buffett is often used as an example of patience, but the real lesson is risk structure. He avoids leverage at the portfolio level, he keeps access to liquidity, and he insists on a margin of safety. Margin of safety means you buy with a buffer against being wrong. Buffett has had drawdowns in market value, sometimes severe, but his structure reduced the chance of forced selling. Charlie Munger talked often about temperament. Temperament is not a personality trait. It is a risk control. If your plan requires you to be calm in a 50% drawdown, you need to prove you can do that or redesign the plan. Jesse Livermore is a different lesson. He made and lost fortunes. He understood trends and tape reading, but he also lived the reality that concentration and leverage can create massive drawdowns. Concentration means a few big positions drive results. Concentration can be rational when you have a true edge, but it increases variance. Variance is the spread of outcomes around the average. High variance strategies can look brilliant until the drawdown arrives and you cannot stay in the game. George Soros is famous for big calls, but the risk lesson is his focus on being wrong quickly. Being wrong quickly means cutting exposure when the thesis breaks before the drawdown becomes fatal. Paul Tudor Jones is known for respecting stops. A stop is a pre-planned exit that limits loss. Stops are not magic. In gaps and crashes, you can get worse fills. Still, the mindset matters. You are not trying to be right. You are trying to survive being wrong. Now, let us talk about a drawdown that does not come from markets alone. It comes from controls failing. Barings Bank collapsed because of Nick Leeson, a rogue trader. Rogue trading is when someone takes unauthorized risk and hides it. The drawdown was not just a bad trade. It was a system failure. Incentives rewarded apparent profits, oversight was weak, and the same person had influence over trading and back office reporting. That is a control breakdown. In investing terms, it is like letting one position report its own risk. It always looks fine until it is not. This matters for normal investors too. You may not run a bank, but you can still have a Barings-style failure in miniature. It looks like hidden leverage in options, or a concentrated bet in a single stock, or a portfolio that depends on one regime. A regime is an environment like low inflation and low rates, or high inflation and rising rates. Regime shift means the environment changes and the old relationships break. In 2022, many investors learned that bonds can fall at the same time as stocks when inflation shocks the system. That is correlation changing again. The drawdown was not just bad luck. It was a reminder that diversification is conditional. Diversification means spreading exposure across different return drivers. It is not owning many things that all depend on the same story. True diversification tries to hold assets that fail at different times. Even then, in a crisis, correlations often rise. So I think of diversification as drawdown management, not drawdown elimination. Behavioral finance is where drawdowns do the most damage. Loss aversion means losses hurt more than gains feel good. Recency bias means you overweight what just happened. In a drawdown, recency bias tells you the pain will continue forever. That pushes you to sell low. Then when the recovery starts, fear of re-entering keeps you out. The market does not need to beat you. Your own brain can do it. So, what is a healthy way to think about drawdowns? First, I treat drawdown as a design input, not a surprise. Every strategy has an expected drawdown range. Expected does not mean guaranteed. It means consistent with history and with the risk you are taking. If your plan assumes a 10% drawdown, but the asset class routinely suffers 40 to 60% drawdowns, the plan is fantasy. The fix is not optimism. The fix is sizing, diversification, and time horizon. Second, I separate temporary drawdown from permanent impairment. Permanent impairment means the value is destroyed and does not come back, like a bankruptcy, heavy dilution, or a business model that breaks. A broad equity index can recover from recessions because it refreshes over time. A single company might not. This is why concentration in single names demands a higher standard of analysis and smaller size. Third, I respect liquidity. Liquidity means how easily you can sell without moving the price too much. In a drawdown, liquidity is oxygen. If you invest in things that lock you up, you must be paid for that with higher expected return. And you must match it to money you truly do not need soon. Fourth, I watch leverage like a hawk. Leverage turns drawdowns into forced decisions. Forced decisions are where you lose control of timing, margin calls, withdrawals, refinancing risk. All of that is leverage in different clothing. Finally, I measure my own behavior as part of risk. If I know I will panic at minus 30%, then minus 30% is not a number on a chart. It is my true risk limit. The market does not care about my feelings, but my future actions do. When you understand drawdowns, you stop asking, how do I avoid them? You start asking, what drawdown can I carry without breaking my process? Because in the real world, the investor who survives the drawdown gets to benefit from the recovery, and the investor who does not survive learns a very expensive lesson about fragility. The principle I come back to is simple. I do not measure risk by how exciting the upside looks. I measure risk by whether I can stay solvent and rational through the worst part of the ride.